A surprisingly hawkish Fed reignites volatility. Popular reflation trades take a beating, and the dollar starts to squeeze the shorts. All this and more in this week's Macro Insight. Welcome back to Macro Insight. Today is the 22nd of June, and let's take a look at markets. And welcome to any free trialers, new subscribers. It's good to have you here. So, all right, lots to talk about. Last week, all about the FOMC. So FOMC surprised markets with a more hawkish dot plot. Signaling that they were more concerned on inflation than the market had expected. Yeah, so that before they've been talking transitory, it's all good. And all of a sudden, we're seeing an updated dot plot that shows projections of potentially 2 rate hikes in 2023, up from 0 that were projected in the previous meeting in March. Okay. So after the we had a knee-jerk move higher in bond yields. But then the long end of the bond yield of the yield curve quickly reversed and took yields to new cycle lows. And that left the yield curve materially flatter, right? So if we look at this here. So this kind of shows the yield curve, kind of what happened. And you can see you've got yields going up in the kind of short dated area, sort of the 3 to 5 year area, and then yields down in the 20-year plus area, okay? And another sort of nice way of seeing that is if we look at the kind of the 5s, 30s, and also the 2s, 10s, you can see here, that curve flattened, right? So the distance between the 5-year and the 30-year point and the 2-year and the 10-year point moved down quite dramatically, yeah, in the order of magnitude of 20, 30 basis points, which is a pretty huge move to happen in a matter of days, right? So what does that suggest? That, to me, that suggests that the market sees premature tightening from the Fed as a potential policy error, right? And that will derail the recovery, and it hence triggered an unwind of the reflation trade, okay? And also to me, it's like the Fed I think the Fed has shown a lack of conviction in their transitory call, right? Making their reaction function less clear and likely increasing asset price volatility going forward, okay? And that's really, I think that's the big takeaway, is that because whereas we thought the Fed was quite reassured in what they thought was going on, and they were in control, and they were perceived to be in control, and they were saying this is transitory, we don't need to change course, all of a sudden they're being much more dependent on that data. And with a couple of high inflation prints over the summer, which we all knew was going to happen, they're all of a sudden kind of changing what they're saying. And that makes you, and that volatility in their reaction function then feeds through to volatility in markets, basically. Yeah. Okay. So now that 5s, 30s move, that magnitude of curve flattening has made investors nervous, right? Because that's a historical sort of move, right? You don't tend to see that type of move in 1 week, right? So, and then when you do see these sort of big shifts, what does it kind of signal? So if we look here, so this is an interesting chart, right? So this shows kind of, this is the 5s, 30s, and you go back, 10, 12 years to see what regimes the market has been in terms of Fed QE and tapering and things like that, and how that 5s, 10s whether it's kind of, how's it moved ahead of certain types of tightening cycle, basically, right? So the idea here is saying that that move in 530s is so dramatic that it's kind of suggesting that the tapering has begun. Like the market's already starting to price in tapering, okay? That's what this kind of diagram is kind of indicating, right? Now, I would say that Wilson, the guy, the strategist at Stanley, he kind of echoes this, right? So he's saying that peak Fed, or what he calls peak Fed, as in peak accommodation from the Fed, right, has already happened, right? So if you look back to 2012 and QE3, we had peak Fed, that was in 2012, and then you had the taper tantrum later on in 2013. He's basically saying that if we look at real yields, 10-year real yields, then he's expecting, we've already seen peak Fed. That was when they announced average inflation targeting. You look at the balance, you look at monetary growth in kind of money supply, right? That peaked in mid-February. He's basically saying that was the tightening that has begun, right? So now you've got people talking about tapering, but really the fact that money supply growth had peaked in mid-February meant that we'd already started our tightening cycle, yeah? And now you're likely to see real yields trade up as we price in tapering, right? And that's likely to happen over coming months, right? And again, you know, Jackson Hole, I think, is a pivotal date because, and I'll show you, and in the report, I've got the Fed calendar there. So you've got key dates where the Fed is going to give guidance and talk, the crescendo coming at Jackson Hole at the end of August, basically, right? But you've got to think that's kind of where we're heading now as they've let the genie out of the bottle, that they are considering, you know, talking about tightening, that the market is now going to start to price in tapering. It's already priced it in quite aggressively, what happened last week, but, you know, it's unwound some of that already yesterday, right? So you're just going to get a bit more choppiness in this narrative and the kind of Goldilocks scenario where they're just, you know, keeping things loose and all assets are rallying. I think it's going to be harder. It's going to be more challenging for that to play out, right? So you know, real yields likely in the short term could trade a bit higher. And that, you know, we'll talk a bit about commodities and how that impacts gold, but it's not going to be great for gold. Question's really going to be how much are real yields allowed to rally before it all starts to fall apart again, right? And, you know, the bond market reaction in the long end suggests it's not going to have, you know, it's not going to kind of take much for growth to roll over again, basically, if the Fed does embark on a tightening, yeah? Now, you know, is the bond market a lead indicator for other asset classes? That's what we're all kind of asking ourselves. You know, there's a few charts in the report that show the 530s and the dramatic shift down in 530s, and is that a lead on some other assets, right? So there's some sort of kind of, you know, decoupling between that and say what the S&P is doing, what the commodity markets are doing, and what maybe some reflation trades like the financial sector are doing, basically, right? So is it a case of the move has begun in 530s, the bond market is leading everything, and other asset classes going to start to reflect that? Okay, so that's the risk, and that's the thing that investors are going to have to get their head around and kind of figure out. Yeah. On the flip side, you know, what about bullish scenarios? I mean, the main sort of thing that's going to save this market, and is kind of arguably preventing this market from rolling over as we speak, is the tech sector, right? So, you know, so here you've got buybacks, right? So you've got two things going on in equities that could save us, right? So even though, you know, what's happened in the rates market is probably raised the probability of some kind of VAR shock across markets over the coming couple of months, you know, the probability of that has gone up as the yield curve volatility filters through into FX, commodities, and crypto, as we're seeing in crypto especially. Equities, however, so far has only seen rotation back into tech and out of cyclicals, okay? And, you know, rather than just outright selling across equities, yeah? So, you know, that's one thing that's saving the equity market, the fact that tech was quite underweight and quite shorted by hedge funds. And there's been a switch back into tech, where tech kind of trades quite in line with the long end of the curve now, as that high duration play. But then you've also got buybacks, right? You've got ongoing buybacks. This year, it looks like record buybacks that we're going to see. So that's going to still be supportive of the equity market, basically, right? So that's what's kind of preventing things falling apart. Also, you had the kind of options expiry dynamic that we'd been discussing, where if dealers have got a load of local gamma, it prevented equities from selling off, certainly on Wednesday, Thursday. The selling kind of, overwhelmed it on Friday as those options were expiring, and we managed to trade down. And then as that expiry is rolled off and the street's got less gamma, we're seeing more realized volatility in equities, but we're seeing it to the upside as well as the downside, right? So it's not clear that we're only going to see the volatility to the downside. And for now, equities, remains extremely resilient, as it often tends to do, basically. Yeah. So that's kind of there. I mean, for me, the rates market, what is it telling us? There's another interesting kind of chart worth looking at here, where if you look at the kind of difference between some of the short dated interest rate futures, okay? So you look at 2 year, you look at DEC 23 euro dollars, they sold off pretty aggressively, right? They sold off about 25 basis, about 15 to 20 basis points. So bringing forward rate hike expectations from the US. But look what the DEC 25 contract did. If anything, that's rallied, basically, right? So, and if you look at what that implies for kind of a terminal rate of where US rates can go, that's looking at like 175 or something, right? It's not even above 2%. So all it's saying is, and we saw similar price action in 2018, where short end hikes that get priced forward are not filtering through to more hikes in the future, basically. So what you're doing is you're saying, we're going to allow a certain amount of hikes. We were parking them 3-4 years in the future, and now we're just bringing them forward, but that doesn't mean we're just going to keep hiking, right? So it's kind of putting a terminal rate there in the belly of the curve at around 2%, signaling that rate hikes will lead to weaker growth and ultimately force more easing down the line if the Fed decides to go that way, right? And that's exactly kind of how it played out in 2018, right? We were going through tightening, they were saying, yeah, we're going to get synchronized global growth. We had Trump put the tax thing through, and all of a sudden we got rates up a bit, and the long end of the yield curve just wasn't pricing any further hikes, basically, and it all derailed, and then the Fed had to pivot, basically, right? So the curve is kind of saying the same thing. So, okay, you can bring your rate hikes forward if you don't like inflation, but all it's going to do is it's going to crush growth longer term, basically, right? So, and that's kind of what's happening here. So it does feel like the Fed is backed into a corner, and any tightening cycle will have to be cut short because the markets can't take it, right? So even if we price in more Fed tightening and a taper sooner rather than later, it's not going to look great for longer term growth, basically, right? So that's, and really, again, this is going to go, and that's why longer term, you don't mind gold, basically, right? Because even though gold might get hurt in the short term, if real yields go up, longer term, it's kind of inevitable that they're going to have to ease again at some point, and then that's when gold will do okay again, basically, right? So now, we obviously look at the gamma flip point and the things that spot gamma put out. So you had that big sort of gamma position expiring last Friday, and the market couldn't even wait really to sell off for that. So I thought the market would probably be free to move after expiry, would sell off. The fact that it started to sell off and go, looked like it was going to break 4,200 on Friday, made me more bearish. So I did sell it by buying some of those short dated put spreads. We got to move down. 41.60 was their first sort of target level. That's where we settled on Friday. We overshot through that over the weekend, and then we recovered strongly, basically, right now. Hard to say if this is a real rally or a fake rally. I don't know. I personally think what's going on in the rates market concerns me. And I think that certainly over the next couple of weeks, there is definitely the potential for more vol. And if we're going to get more vol, it's more likely to the downside than the upside, in my opinion. So I'm a bit more nervous on macro, even though we got that knee-jerk move yesterday, that reaction yesterday. I would still be pretty wary. I'm not looking to get super long risk right now. I'd rather let the next 2 weeks play out into the end of June. Let's see if we can get through that without a wobble and feel more comfortable about the outlook. But at the minute, yeah, I trimmed pretty much most of my tactical trades because I want to just wait and see and let this thing play out basically for now. Yeah. Obviously Nasdaq had a strong recovery too, benefiting from the rotation, but even Russell, right? Russell had a really strong bounce yesterday, but if that is your more cyclical play and we're going to unwind the reflation trade, then you're going to get that growth value rotation back out of the things like Russell and back into things like tech, right? So it's jury's still out on that one, basically. I think the European story, similar thing, Europe's been benefiting from the value trade. Is that going to take a bit of a pause now if we're going to go into taper discussions for the next 2 months? So Europe, again, might be a bit vulnerable in the short term. Longer term, Europe looks okay, into the back end of the year maybe. But in the short term, yeah, Europe could be vulnerable to a sell-off. And if you look at the bounce in Europe's not quite as strong as, say, the S&P, right? So that might be a safer place to play a short in the very short term, given the price action and given the fact you think value might be the thing that suffers if the reflation trade is kind of unwinding a little bit. And then you got Asia as well, right? I mean, India's been pretty stable. It hasn't really sold off yet. Given that the dollar rally, I would have thought EM would come under a bit of pressure. China's remained weak, but that's been a bit of a dog for a while, China, right? So you've got some people actually thinking China equities are quite good value now, given that they've been quite weak. But I would just say be wary of what's going on with the dollar, right? If the dollar, we'd been saying that downside momentum on the dollar had been going away. And we've been saying that there was a chance of a dollar bounce over the summer, and it looks like that is materializing. And that's just going to not play very well for EM in the short term, right? So I think, longer term, maybe getting into some EM equities on a 6-month view might be okay, but on a 1 to 2 month view, you're likely going to get better entry point if the dollar stays firm. Yeah, and that'd be where I'd maybe look to opportunistically think about scooping up some EM exposures in a strong dollar over the next sort of 4 to 6 weeks, maybe something like that. Yeah. So that's kind of where equities are. I mean, VIX, very choppy VIX, right? Bottomed out around that 15 level. VIX expiry last Wednesday, had a cheeky down print. We got lucky on some VIX puts that we kind of kept in the book because they actually expired in the money. And then we got the move up in VIX. VIX topped out at around 22 and look how quickly it's rolled over again. I mean, very, very high vol of vol. And that's something that, has been flagged that despite vol going down a lot last week before expiry, vol of vol was relatively high and it certainly remained that way, right? So vol being very, very choppy. I personally think it's likely that 15 is probably a low in the VIX for now, given the kind of Fed reigniting volatility last week and the fact that the move index has popped. I think that's probably going to keep a bit of a floor under the VIX over the summer. If interest rate volatility is back. So, I'd say, VIX unlikely to kind of, I was thinking the VIX might head down towards kind of 12 to 14 area over the summer if the Fed had done nothing or hadn't really screwed it up like they did last week. But the fact that they did what they did probably makes it fairly unlikely now, I think, for the VIX to break aggressively below 15. Yeah. So I wouldn't really be looking to play that. So I'm not going to be rushing out to buy any VIX puts anytime soon right now. Yeah. All right. So that's equities. If we go to the dollar, which obviously, or the king dollar, dollar wrecking ball, whatever the Real Vision guys want to call it. It's been the bounce we've been waiting for a long time, finally arrived. So, you had it basing for a long period of time, losing all its downside momentum. And now finally we're at a thrust up from like 90.5 to like 92.5. Decent sized move. 3-day move in dollar. Apparently that was like a 6 sigma move basically in the dollar, right? It was pretty punchy. Now, upside momentum, as we traded up, the momentum was pretty extreme, right? So suggests that the move probably isn't done just yet. So could we see 93.5? Very possible. I mean, some guys are thinking we might even get all the way back up to 96, 97, basically over the summer. It's possible, right? I mean, given that the 2-year part of the curve is the one where it was probably driving FX rates more, right? So even though the long end rolled over again in yields, the hike in short-term yields is what's going to keep the dollar up, basically, right? So you got to think, given that there was some dollar shorts being added last few weeks, there's a bit more unwinding, a bit more squeezing to be done as we get more and more taper talk, unless we suddenly get the Fed completely walk back everything that they've done last week, which is possible, but probably a little bit less likely, I would say. They probably need the markets to throw a bit more of a wobble before they walk it all back. So I think, path of least resistance is probably for dollar higher, can probably push higher as tapering gets priced into markets over coming sort of couple of months, right? That'd be my feeling on the dollar. Obviously, that means for euro, not so positive on euro. So what could we see? Obviously, our next obvious target on the euro is going to be around that 117 level. So we'll see if we can manage to get there, but it's just a bit of a mirror image. And then on the pound, 136 is big level on the pound in terms of support. So maybe that's where we're headed, basically, around 136 on the pound. If the dollar does want to go higher, that's going to be your next key levels to watch. 136 on the pound, 117 on the euro, and DXY is going to be around that 93.5 level, basically, right? That's going to be your obvious kind of next target if this move is going to have some continuation to it. Yeah. So on the strong dollar, that's obviously not great for commods. And as a result, commods took a bit of a beat down. Now, the gold move was pretty impressive, right? So if we talk a bit about the gold move, what happened? Gold got punished after the Fed the Fed's pivot simultaneously crushed inflation expectations and sent US yields higher at the same time, right? So real yields moved by about 20 basis points, right? Triggering collapsing gold, and it took out that 1825 key support level. So you see that downtrend there where we've got above, looks like we've got a false break there. We went back below 1825 and collapsed, and we got back down to this 1760 confluence level, right? So, gold now, anyone's guess, right? A bit no man's land. And even though yields kind of retraced back in the long end, taking real yields back down slightly, I'd say the stronger dollar, which is being anchored by the short end rates, that's what's kept gold from really rallying back, right? If you had the dollar pull back considerably, then gold might have got a bit of a push. The fact that the dollar kind of stuck up there with the short end of the curve means that gold's kind of struggling to really move in sympathy with real yields because of the dollar dynamic as well, right? Because that's the thing about gold. It has very strong correlation with real yields, but obviously the dollar plays a part as well, basically, and the dollar's been very strong. So, as more tapering and Fed tightening gets priced in, it's going to make things difficult for gold, right? But if the long end of the bond market is correct and the Fed likely goes back to easing soon enough, then gold's going to resume higher. So really all about how much of a tightening cycle are we going to get to price in before the market just says, no, it's not happening. Bond market's already signaling within a week that, are you sure you want to make that policy error, right? Equities has managed to shrug it off for now. But if we continue to price in Fed taper over the next month or two, then equities could wobble, gold could wobble some more, and then, there'll be pressure potentially on the Fed to walk things back or even, start easing again at some point, then that's better for gold. So I'd say if you're going to be a buyer of gold on this dip, you've got to be prepared for some short-term weakness. And that's why in optionality, I wouldn't really fancy owning optionality anything sub 3 months, because I think you might need more time for this gold bull move to play out, basically, right? So for me, you either want to be allocating longer term, just straight delta one into gold on any dips, but the dip could go quite far, right? If they really do price in tapering, and you see a big move up in real yields, we could break those 1680 lows in gold and see new lows, right? Down to maybe 1500. And if you're comfortable with just owning gold and seeing it go down there and not worrying about it, then that's fine. If you want to use optionality so you're protected, then like I say, I would probably look a bit further out and maybe even into early next year, March next year, gives you plenty of time. And the good thing about gold is vol's not crazy expensive when you go further out the curve, right? So it's not like the term structure in gold is so crazy steep that you're paying a hell of a lot of extra vol premium for those longer dated options. So, for me, I think the vols popped clearly a bit last week. But I bought some gold calls, they've lost money because obviously the premiums dropped. But I bought these calls a while ago when the vol wasn't that expensive. But I'm kind of glad I bought them so far out, because that gives me plenty of time for us to kind of look past tapering and start to look into easing again later in the year. And then maybe that gold trade comes good, basically, right? So that's kind of how I think about it. But for those who haven't really allocated to gold much in their long-term portfolios, then dips in gold over the coming month or two will probably be a good opportunity to accumulate and have some gold in the book for, that later pivot back towards easing that is inevitable. Right? There's no way we're not going back towards easing at some point. It's just a question of how long the tightening cycle is going to last, right? And it seems that tightening cycles are getting shorter and shorter if we look back, right? So that's the kind of the way to think about it. And in terms of how far gold could actually go up, God knows, right? I mean, if the kind of stuff that Luke Roman's been talking about comes true, and he's talking about negative real yields of -5 to 10%, then gold could really go to the moon longer term, right? So I don't know. I'm not smart enough to know if that's true or that's going to play out that way. But what we do know is that given the crippling amount of debt, there is going to be a tendency to want to have financial repression and to want to have negative real yields, right, over the longer term. So that dynamic is in play. Yeah. Oil, amazing resilience in oil, right? I mean, it barely moved on the dollar rip, basically, right? And generally, you do see broad-based commodity weakness when the dollar rips, and oil just said not bothered, right? So clearly the oil market is being driven by a different dynamic. The kind of things that they are caring about are rising demand coming from the global reopening. You're seeing the likes of India coming out of the worst of the pandemic, and they're a massive consumer of oil. You've got OPEC maintaining a cautious approach on production. So there's just this sense that supply growth is going to lag demand by a long way in the oil market. So, and it's almost like they're targeting the price, right? OPEC happy to see oil like WTI 75, Brent like 78. That seems to be where they want to take it, basically, right? And barring some massive shock on growth, they're probably going to be able to get it there, basically, it looks like, right? So no point fighting that in oil. In terms of other commodities, clearly copper's been very topical. What happened in copper, China's been kind of going after the speculation and things like that, and selling copper down a bit. Perfect pullback to one of my confluence levels around 410. It's bounced smalls off that level. Is the copper correction done? Hard to say. I would argue if the dollar move's not finished and we're going to get more taper talk, then I would favor we're probably going to break that confluence and maybe go down to 200-day moving average around 375. If that happens, close your eyes and buy it, basically. Right, that's probably what I would do. I've already got some in the long-term portfolio. I closed down my tactical stuff just because I was nervous on the general macro environment last week, and I just thought there's just too much choppiness all over the place, so I'm just going to shut things down. If we get down to that 375 level, I'll probably be buying more in my long-term book, basically, right? Because that's a pretty tasty entry point, I believe, for what is likely to be a long-term super cycle in copper, right? Driven by the green agenda, the clean energy and the green transformation, right? So that's copper. So that's kind of my thoughts on commods. You know, like I say, use dollar strength over the summer to get into commodity themes that you like, right? Whether it's uranium, right? Whether it's copper, things that you structurally like, longer to whether it's rare earths or whatever, right? Things that you structurally like, that you know there's going to be a demand for over the next decade. Those are the things to scoop up and take advantage of these pullbacks in commodities, basically, right? And that's certainly what I would be looking to do. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.